analysis. So what we will be doing is we will be looking at a deal, and especially from a finance career perspective. That is what we will be going to do today. Okay, so let me start by sharing my screen. Is my screen visible?
Yes.
Yeah, great. So let's start. Look at what is deal analysis and why it is important. So this is the overview for today's session. A little bit about myself and about GoCrackIt and what we do at GoCrackIt. Why do finance careers need deal analysis, right? So deal analysis is a skill set that one needs to develop for specific finance careers, not for all finance careers. So we'll look at which careers, why it is required, and then immediately we'll deep dive into doing a deal analysis. And this will look at from both strategic perspective and financial perspective, right? So what we typically call as qualitative as well as quantitative analysis. Most important, right, to defend the deal analysis in your interviews, right, or even in front of your clients when you're there in the finance careers, you need to build your own point of view for the deals that you have analyzed. And I will also share some resources that you can use for doing more such deal analysis, right? So that is what is going to be the agenda for today. So a little bit about GoCrackIt. GoCrackIt is a career mentoring platform. So we have mentors who are from different industries and domains who mentor professionals and students towards different careers for helping them to have successful careers. We were incubated at IIM Bangalore's incubation center called as NSRCL. In our journey so far, we have mentored more than 23,000 students and professionals across 61,000 mentoring hours, in which we have done 33,000 mock interviews, 19,000 resume reviews, and more than 2,500 plus such one-to-many and group discussion sessions. So that has been our journey so far at GoCrackIt. These are some of the mentors that we have. Most of them are alumni of top B schools across the country and working at aspirational companies. So we have mentors working at, from a finance perspective, let's say at Goldman Sachs, at Avendus, at Kotak, ICICI Bank. So all sorts of finance companies from a tech perspective, folks working at Amazon, Flipkart, Google, Microsoft. So we have mentors working at aspirational companies who, because they have been there, done that, can help students and professionals do well in their careers. Little bit about myself. So I am Suhruta Kulkarni. Did MBA from IIM Ahmedabad 2006-8 batch. Post that, have been working in the investment banking space, where I've done deals across infrastructure, construction, F&B, music industry, amongst different industries. The deals were done. So these deals were basically fundraise kind of deals that we were doing for both equity as well as debt. Apart from that, I have also worked at IIM Bangalore, wherein I have co-authored case studies along with the faculty over there, which are published at Harvard Business Publishing and University of Michigan. So far at GoCrackIt, have mentored more than 3,000 plus students. Again, majorly across finance and strategy area. That is where my expertise lies in. Alok is my co-founder, who comes with around 20 years of experience across technology, product consulting, and operations background. He's an IIM Bangalore alum. He has led digital transformation, cloud mobility, ERP, and other such projects across large infra, automotive companies, real estate companies in the country. He has again mentored more than 5,000 plus students and conducted 150 plus such workshops. These are some of the B2B schools that we work with. And yeah, these are some of the offerings that we have. So we help students and professionals start with career exploration, help them prepare, practice, support them, and also help them during their internships. That is what we do at GoCrackIt. So why should we do deal analysis, right? So typically for careers in investment banking, private equity, corporate finance, equity research, consulting, amongst others, right? So these are the top five that I have picked. They need you to understand deal analysis. Reason because, for example, investment banking. What is the role that you do at investment banking? You help corporations in their financial transactions. Now, a corporation might want to buy a company for technology, for consumer base, for geographical expansion, multiple reasons, right? That you might want to buy a company or sell a company, right? Now, if you have to do this, you need to figure out what is a good deal. What valuation should I buy this company for? Is this company even good to buy? So you need to start thinking strategically, then you should do financial analysis, and then you come at a valuation, then you do negotiation, and you actually close the deal. So for investment banking as a role itself demands that you do this day in, day out, right? Private equity, right? If you're targeting career in that, you are going to make investment decisions, right? So what kind of returns can we generate if we invest in XYZ company, right? Again, that is where deal analysis is required. If you are in corporate finance or strategy role, right? So let's say that you are part of the Aditya Birla group, and you're part of the corporate finance team. Strategically, the group decides that let's get into gold mining, right? I mean, gold, your price is rising. So let's do gold mining as well. There are some mines that we should look at. Then they are thinking whether we should build these capabilities internally or should we buy, right? So make or buy. Once you decide to buy, again, you need to do the deal analysis, find out companies which are doing this and what valuation you should buy this company. Similarly, for equity research, right? Uh, if you are, advising clients on buying stocks, selling stocks, you again need to analyze this. And in consulting, right, where you are advising client more on the strategic side to ensure that they get the competitive advantage. So, thus, deal analysis as a skill set is very important for some roles, right? Again, as I said, for not all roles in finance, some of these roles it is important. So, what is a deal? For example, there is a deal or a potential deal ongoing, right? So, Netflix is trying to buy a part of the Warner Brothers called as Warner Brothers Discovery, right? Now, Netflix had given a bid to buy this. Okay, now why Netflix wants this is a question that we need to ask. Why does Warner Brother want to sell this is a question that we need to ask. So typically these deals are done based upon the synergies that the deal will unlock. What do you mean by synergy? Instead of there is one entity, there is second entity. Both have certain strengths, right? Now if they merge together they will perform better, right? Financially, competitively for the consumer on multiple parameters operationally. That is what is called as a synergy. That two is better than one, right? Now, here Netflix could be looking at content when they're buying out this. Now, Paramount, which is another company in the media and entertainment space in US, has given a bid, an additional bid, saying that we will buy this. Now, Paramount and the entire film industry is concerned that Netflix will reduce the kind of movies that get generated for the theater experience, because Netflix is an OTT, right? It is not interested in theater content, right? So that is what the issue is about. And again, the deal is not yet closed, but this is a deal. In India, for example, HUL has now, it has already kind of completed the acquisition of Minimalist. So HUL is your Hindustan Unilever. Minimalist is a new age startup brand in the beauty and skincare industry. Why did HUL buy Minimalist? What were the synergy is in that? We will look at that in the next session that we do. A few years ago, Zomato has acquired Blinkit. Now, if you look back, right, now that we are in 2026, right, and when you look at the Zomato Blinkit acquisition, Blinkit is really contributing well to overall Zomato's revenues, right? So this entire synergy unlocking has actually happened. Given that at that point of time, probably the deal may not have made that much sense given what Zomato was doing. However, hence even for this deal making, what you need to have is strategic vision. right? When a company is spending today expecting future strategic and financial benefits, right? That is where uh, the visionary strategy management comes into picture, right? Yeah, here are some JDs. As I said, this is taken from IIM Jobs. Deal team analyst, right? So this is a company called as Aristo Consultants, which require you to have the skill set of deal analysis or equity capital markets, right? Deal syndication. So they need somebody who can bring in more deals for the company to execute them, right? Or a deal analysis, right? So these are some of the careers which need deal analysis. Now, let's get into analyzing a deal. Okay. So a few years back, Reliance that time wanted to, let's say, acquire Disney Hotstar. Now it is already completed. Now we can do the evaluation for this. Okay. Now, before you start a deal analysis, what you have to look at? Look at, as I said, first from a strategic perspective. What are the synergies? What is the business model of both the companies after the deal, right? After the merger or acquisition is completed, what is going to be the business model? So this was a merger, right? Reliance has not completely acquired Disney Hotstar. In the merged entity, Disney Hotstar still has a significant stake, and we will look at the numbers. Then you can look at the financials and you can look at what valuation. So let's analyze, right, from a strategic perspective first. Why? Why now Reliance here is on the buy side and Disney Hotstar is on the sell side. Okay. So why did Reliance want to buy Disney's India business, right? So Reliance at that point of time already had laid down the entire, geo network. Now the internet usage will significantly go up when people use it not just for work but for entertainment as well. So geo telecom would be needs to be powered with content. Geo Hotstar had Star. They also at that time point of time had the IPL rights, right? Geo Hotstar had the IPL rights at that point of time. That is when Reliance decided. Now cricket is one, where content really matters, right? So they wanted to leverage their already existing business with content, right? Also, now it is not just about today or tomorrow. India as a economy, India as a market is a growing market for entertainment, right? Needing multiple types of content. Disney Hotstar already had great content. That is where it made sense for Reliance to buy Disney Hotstar, right? On the other side, why did Disney wanted to sell? Now, what happened? While they did have rights earlier, in 22-23, Reliance won the rights for IPL. With the loss of IPL rights, the subscribers for Hotstar reduced significantly. Now, Disney played on premium content. They could survive only if the average user's revenue, right? ARPU, average revenue per user, was high and as per the global standards, right? What Disney typically gets across. In India, that is not the case, right? We take a 49 rupees, 199 rupees, 299 rupees kind of a subscription, right? And we want everything in that, right? But Disney could not play on that kind of a low ARPU, right? So Disney was already kind of, not doing well because of the conditions of Indian market. Now, Reliance, on the other hand, right, it has a massive distribution, so it can play a long-term game. That is what it did with the internet also. It gave a lot of free plans, and now it is, kind of becoming the entire powerhouse. So that is where Disney decided to sell out because it could not compete, right, at this level. It could not compete with Reliance or other, or even international players with what they had. And that is where they thought that this is more, better. But they retained 36.84% stake in the merged entity. Why? Because they knew that this market is going to grow, but operationally, Disney didn't have the wherewithal to actually implement it. So they decided, let me have a stake in the upside while I get out of the operational risk. Let Reliance play the game. I still hold a stake in that, right? That is the deal, right? So Disney didn't do a full sell off, right? They still have a stake in the deal. Again, reason is that India is a growing market. While the ARPU's profitability are high in other markets, the growth is happening over here, right? That is the key. So that is the the strategic analysis of why Reliance wanted to buy. So it should make sense to both the entities, right? There are some deals, okay, there are some deals which happen against the choice of an entity, which is a forced takeover. Okay. So that is what you see typically in leveraged buyout deals. For example, the KKR Nabisco deal, right? So KKR was a private equity firm and it did a forced buyout of the RJR Nabisco company, right? So they kind of took all the shareholders, they paid them extravagantly. They got the company. Eventually that did not flourish. Okay, I mean, eventually they had to cut out different stakes and sell it off, right? So all kinds of deals happen here. Both had strategic intent for buy and sell, which is good and which works out, right, later for both the companies also. So what we can see here, right, as you know, so there are, now the deal was done in a very different manner, right? There is Viacom 18, which is again entity with Reliance having ownership and Viacom Media having ownership. So that company owns Geo Cinema. So they are there, Reliance is there, and Disney is there. Okay. So uh, with total stake of Reliance in this entity and in Viacom, Reliance has a total stake of 63.16%, Disney has 36.84%. Okay. Now, Reliance has additionally put in 11,500 crores as well in the joint venture to fuel growth. Okay. So let's look at what everybody brings to table. So Reliance Industries, 16.34%, Viacom 18, which is Reliance controlled, 46.82%, the Walt Disney Company, 36.84. And what all did they bring to the table? Reliance brought in direct cash plus part of their contribution via the Viacom 18, right? Now, direct cash is also important, right? It's not just two entities and hence they'll figure out what to do. No, I mean, they have to make new investments to get those new customers, right, for their joint entity. Then Viacom 18, they owned Colors, okay, and different sports content, Geo Cinema, that came into the deal, and Walt Disney with its Star India, Hotstar, that came into the deal along with the not entire Disney's content library, but major part of it also came to the deal. So this is what, so you get a stake based upon what you contribute. You can contribute in cash, you can contribute in different assets. Sometimes the contribution is just the brand, right? Even that carries a huge value, right? Because brands do matter. Trust is there in brands, right? Now, so this is what the deal is done. But now when you go for finance interviews, right, they'll ask you what's your point of view on this deal. Do you think this was a good deal, bad deal, what, right? So now in August 2025 there was this news item that Disney cuts projected loss from its stake in Geostar to 200 million. Now what do you mean by loss? Because if you read this article, this is the article, okay, Disney cuts this loss by whatever this. Now, GeoStar, which is the total merged entity, that is not a loss-making company, right? That is making profits. So then why do they say that Disney has reduced loss? So earlier it had projected a loss of 300 million. Now there is a loss of 200 million. So this is less than a cash perspective, it is more of an accounting perspective, because Disney has given up its certain assets, right, to this entity. And see, earlier they had revenue stream from Star India, right, all the channels that they used to play. Now that is going into the merged entity, so the Star India revenue doesn't come directly. They just have 36.84% stake in the entire entity, right? So they can attribute 36.84% to that profit which Geostar is making. That is what comes into Disney. However, the assets that they have given to the merged entity, Probably they were valuing it higher earlier. Now, given the deal that was cut to them, so Disney, I mean, all said and done, they were kind of on the losing side, right? So Disney did get a lower valuation for their assets. Earlier, they had thought 300 million was the loss. That is what they've done the accounting. Now they have moved it to 200 million. Again, that reduction happened because GeoStar is still performing well, right? So this is what happened after the deal was over, right? So what's your point of view, right? So for Reliance, right? So they just didn't buy additional Star India earnings. What Reliance, for from a Reliance point of view, we bought the strategic control for India's attention economy. They have the entire, distribution. They have the cinemas. They have Star and Colors, which are the most watched, kind of channels across the country. They have even, new age kind of content over there. So that is the point of view from Reliance. Now this builds a very strong moat for them. It is not easy now to crack in the Indian entertainment industry, given what Reliance has with this deal, right? That is what Reliance has got. For Disney, right? Now, as I said, for Disney, because they were struggling, right? So they traded operational control for risk reduction while preserving long term upside. They still own the stake of 36.84% in India's most growing market, right? Now, just don't stop at this, right? Again, do a little comparison of this Reliance Disney deal versus, let's say, another deal. So, Warner Brothers Discovery deal had also happened. Now, again, Warner is selling this Discovery. That is a different story. Now, both the you can do this deal comparison. However, it is important to start from the strategic intent. Here, it was more about growth and ecosystem control. There, it was more about survival and consolidation, right? When Warner Brothers brought out Discovery, Discovery was struggling a lot, right? That is where it kind of completely took it over. That is where the full merger happened. Now here both are owning, right? So you can see here this is not Disney was struggling, but Disney was not desperate, right? So hence they still own that stake. Here there is no stake, right? Warner Brothers kind of completely own it. Now this is the part which Netflix is now going to buy. Why? Interesting thing. Maybe we can explore in another session, right? The ARPUs are different. Look at this. India ARPU is between $5 to $7. There it is $100 to $120. So these are just the space is similar, but you at least have something to compare a deal with, right? So it also helps to compare a given deal with another deal to find out where one could have done better or where one actually got the strategic advantage. So to summarize, this is like an M&A framework that typically you can use for deal analysis, right? Where you can look at financial feasibility, synergies, and business model, look at exit options and risk, right? So here, as Disney has a partial exit that we saw, Discovery did a complete exit, uh, and sometimes the entire entity can also separately go for an IP. There are multiple things that you can analyze from a deal perspective. A lot of times people ask about where do I know which deals are happening. So there are multiple resources. You can go to, let's say, Big Four, right? So this is PwC's Global M&A Industry Trends. Similarly, they also do an India industry M&A trends, and very very interesting outputs that they have on that. Then there is your Bain and Company. Now look, if you just go and click this article, you will look at what happened in 2025. Then they also have a related article on what they're expecting in 2026. Now again, if you're preparing for finance interviews, right, it is also important to have a point of view on what is going to happen in future given what has happened in the past. So these are very good articles to read upon to look at where deals come from. This is Morgan Stanley. Again, five forces driving M&A. So AI AI is going to play here at two levels, right? One is the deals happening in the AI space, right? Because the pace of growth is so fast that even larger companies are buying out very small startups if they have really good tech created. That is one. On AI leading the deal making space. Second is AI is also, so before, earlier you have to do a lot of research for the deal analysis part of it. Now AI is taking care of that in actual deals. Okay, again human judgment comes in, but a lot of grunt work or leg work is done by AI, right? So that is how AI plays at two levels in the deal analysis part. That's all from my end. Any questions? I can take maybe one or two questions, and then we can close the session. Any questions? Okay, great. Then thank you so much on attending on Sunday and on budget day. Hope you continue watching what's happening on the budget end. Thank you, everyone.
Thank you, Suhruta.